Q3 2025, Toronto and Ottawa's economic and market trends amid turbulence. Growth is forecast to slow throughout the rest of 2025 and may actually contract in 2026 if the new federal government is unable to gain concessions from the U.S. The Bank of Canada maintained its overnight lending rate at 2.75% throughout the summer, although economists now believe the likelihood of further rate cuts before year's end are increasing as our economy teeters on the brink of a recession. Although unemployment rates in U.S. tariff and trade areas like Oshawa and Windsor have risen sharply this year, half the provincial increase has occurred in the Greater Toronto Area. Q1 2025 transactions were moderate at $3.6 billion, down 6% year over year, while Q2 volume was down 22% to $7.2 billion. Retail has rebounded despite the demise of the Hudson's Bay chain, with food-anchored retail and mixed-use redevelopments providing the bright spots in a 59% year-over-year increase to $935 million. The office sector remains troubled with high vacancy rates and Q1 transaction volumes down 38% year over year. The flight to quality continues, with Class A office performing better than any other segment. Fast-tracked approvals for modular and prefab designs and increasing the use of mass timber could cut build times between 30 and 50%. The skilled labor shortage and training gaps need to be addressed at the federal level to increase labor mobility between provinces while linking immigration to skilled building trade workers. The federal government's plan to reintroduce a form of multi-unit residential building tax provisions, or MURBs, should help make affordable housing builds more viable. Federal plans to cut development charges by 50% will also be a boon to the multi-residential market. Uncover key insights shaping the future of Toronto and Ottawa in our full report produced by Canadian Real Estate Forums.